Now, household net worth in the U.S. saw its biggest decline since the financial crisis at the end of 2018, down to $104.3 trillion and 3.5% loss overall. Much of it has been attributed to the volatile stock market at the end of last year. Mike, what's your take on this? I mean, net figures have been pretty good for most people's wealth over the last year. This is a sort of
coming off high levels. I call it the snapshot effect, right? I mean, we just decided we're going to take this look at the end of a quarter because that's when the data is available, and that was right after this huge plunge in the stock market. And so I do think it helps explain perhaps a little bit of the negative wealth effect response that we're seeing evident, for example, high-end retail in December. I think the second half of December was a tough spot if you were trying to sell anything expensive.
Well, it does sort of raise a question, Stephanie, about what the consumer is going to do this year and whether it can continue to carry us. The U.S. has been an outperformer in the world, and that's thanks largely to the U.S. consumer.
Yeah, but remember that we've had the best start in the markets in the first 2 months of this year since 1991. And that's a big, big number, right? We're up 7%, even with the 2% pullback that you talked about. We're up 17% from the December lows. That's got to do something for psyche and household net worth, right? So I think you're going to get a snapback. I absolutely was worried about the retail sales number in December. I think it's a one-off. I think retail sales is a very highly revised number, one of the most revised numbers from the government out of all the things that they release. So I think you're going to get a snapback in the consumer. Jobs are good. Wages are good. Let's see what they say tomorrow. Wages, we're looking at 3.3% annualized. That's a good thing in my mind. I think the consumer is just fine, and I think we had a blip. And I think it was warranted given the sell-off that we had in the market, and I think we're back on track.
But overall, therefore, Stephanie, do you increase your exposure to domestic U.S. cyclicals if the data, in a relative sense, isn't perhaps necessarily improving, but it's not getting worse like people thought it was?
Yeah, I actually have a very much of a cyclical bias to my portfolio, and it's also been more exposure to the international markets as well, as we see them recovering or at least stabilizing, particularly China and the EM. But I do think that the data that we've been seeing, even in this past week, is a bit encouraging, right? It's a little bit better in terms of productivity, in terms of the services ISM. The new orders number in the services ISM was the best since 2005. I mean, these are good numbers. So we got, obviously, the slowdown that we were all expecting, and maybe we're just stabilizing here. And as we get better with a very accommodative Fed and a very accommodative central bank policy around the world, that's very good for risk assets.
So